Hi, thank you for joining this mini webinar. It's going to be really crisp and short to the point webinar. Before we get into the presentation, let me just take a couple of minutes to introduce myself. I am CA nrajca, Chartered Accountant by qualification, a teacher, trainer by passion. I started my career as a banker, credit analyst with State Bank of India. Worked for a period of 4 years. In very short period, I had the opportunity of becoming team leader, credit processing cell. So worked on 250 plus projects. It's 5,000 crore plus size. Then came out and started my CA practice. Had my practice for a period of 7.5 years. Alongside had this teaching training. Thanks to technology, today through online, I teach 2 lakh plus students all over the world, basically on banking, credit and financial analysis, and majority of them are working banking executives. I'm really glad that my courses are helping them, and I'm sure this course will be relevant and useful for you as well. Let's get into the webinar. In the last session, we have seen analysis of this previous year 2, which had substantial deficit. In this session, we'll do the analysis of previous year 1 and focus is estimate vis-a-vis actual. Let's see what they have promised. They promised saying, or they promised that their business will generate cash accrual of 7.41 crore. Of course, they did not promise anything on equity loans and all, but they promised of infusion of unsecured loan of 1 crore, and they said they'll be mobilizing 9.41 crore of long-term funds, and they are not going to create any assets, but they are going to utilize it for some long-term uses. Okay, some long-term uses. It can be loan repayment, and what are the other purposes not very clear, or the breakup is not available. So they promised of infusion, or they promised of raising long-term funds of 9.41 crore and long-term use of 6.04 crore. Okay, so they were expecting a surplus, because out of 9.41, 6.04 will be used, and surplus will be 9.41 minus 6.04, 3.37 crore. So this is what they promised. They gave it as estimate. Let's look at the actual. They promised generating cash accruals of 7.41, but they ended up in making a loss of 10.67 crore. This is a huge deviation. This is a huge deviation because they promised a positive 7.41, whereas they ended up in negative 10.67. So if you look at the deviation, it is actually 7.41 to 0. So that 7.41 crore is itself a deviation, okay, plus 10.71 negative which they went. So the total deviation here is 18.08 crore. If you express this 18.08 crore as a percentage of 7.41 crore, it's almost how much? 244 percentage deviation in terms of generating cash accruals. So what went wrong? Why this business was not able to generate cash accruals? Because cash accruals is nothing but, and when we say cash accruals, this is nothing but PAT plus depreciation, then plus or minus non-cash items. Okay, so what went wrong? Is it that they have reported loss, or is it that depreciation is different from what was estimated? What went wrong? That got to be studied and brought out in the proposal, especially the reasons for deviation from the estimated level. Of course, they promised unsecured loan of 1 crore, they have infused it, it's good. And they've also raised some money, some long-term money of 1.89 crore. So they have raised 1 plus 1.89, 2.89 crore, but they lost 10.67 crore. So eventually they lost 7.78 because it's negative, these two positive. They lost 7.78 crore. Fine. It's not fine actually. Okay, they lost. But on the other side, when they don't have funds, they should have kept quiet. They did not make any investment in capital asset. but around 10.85 crore had gone under other head. They don't have money here. They don't have any long-term funds. It's negative 7.78. And they are investing 10.85 crore into other items. What are those items? See, this others can be loan repayment. It can be loan repayment. It can be investments in subsidiary, associate concerns. It can also be loans and advances to subsidiary, associate concerns. So these are actually a diversion. These are actually a diversion, right? So here this 10.85 crore, we don't know what is the split up. If I assume that out of 10.85 crore, let's say around 6 crore is loan repayment, because that was estimated last year itself, it means another 4.85 crore had gone for the purposes which were not originally envisaged, right? So this is not the right sign. Why? Already they were losing. They lost 7.78 crore and they are investing 6 crore, which was of course estimated, but another 4.85 crore got diverted into some heads, not sure what it is. So if you notice, 10.85 is the long-term usage, 7.78 is also long-term use because it's a negative figure. So totally 18.63 crore is the deficit, and again there is a serious concern now because there is no long-term source. It's fully long-term use. So from where they would have got this? Obviously negative working capital. It means current liabilities are greater than current assets to the extent of 18.63 crore. And these guys, if they ask for payment, this entity will be in serious trouble because they have invested them in the sources, in the areas which will not come back within 1 year, or it's a loss. It is not going to come back at all. Okay, because this 10.67 will never come back. Out of this 10.85, if this is a 6 crore repayment, it is also not going to come back. So what can be expected to come back is 4.85 crore, but it is almost gone. It is also not going to come back. Then this entity's survival is questioned. Okay, whether it can go further or not itself is a big question mark. Okay, so that got to be understood and brought out in the proposal. Given this high level of deficit, how you are going to convince the sanctioning authority for the estimates and projections? Because look at the estimate vis-a-vis actuals. We'll do the comparison. They said they will mobilize 9.41 crore, but they actually lost 7.78. They said they'll use only 6.04, but they have used 10.85. They said they will contribute to working capital 3.37, but actually they have stolen from working capital 18.63 crore. So estimate vis-a-vis actual is in very dangerous situation. Why? Because they are not fulfilling any of the promises. So how you are going to justify the sanctioning authority for these estimates and projections? That by itself is a challenging task. Let's look at this also. They are promising cash profits of 1.76 crore and they are saying that there will be infusion of 5 crore unsecured loans. Why? Because this organization was bleeding. It was suffering huge cash loss. So unless and until some kind of a funds comes into the system, it is not going to help them. But more than unsecured loan, what is relevant for this firm at this point of time is equity. Because due to continuous losses, the net worth of this entity would have come down. It is possible it will become negative also. So to restore the net worth, to restore the shareholders funds position, earlier position, shareholders got to invest once again, no other go. Okay, so what is more appropriate here is equity, but okay, given the time frame, or given this scenario, it is coming in the form of unsecured loans. If this unsecured loans is from shareholders, unsecured loans from shareholders or say promoters, it will be well and good. If they are unsecured loan from some other financial institutions, again with heavy repayment obligations, then it is going to worsen the scenario. As a banker, you should ensure that there is a high level of certainty regarding this unsecured loan. Because if this unsecured loans are not coming, then instead of 7.62 crore, what will be there? It will be only 2.62, and they are expecting some repayments. So eventually it will also result in negative. It means estimating deficit in fund flow statement is the worst situation. Because if you are saying that in the current year they will land in deficit, they will divert current liability for long term purposes, it means you are estimating that this company or this entity will go for suicidal. Okay, so estimating deficit is dangerous. It means customer should come out with some plan to avoid a deficit. It does not mean that you have to manipulate the fund flow statement in such a way that there is a positive figure. No. You should sit and talk with customer, explain the scenario, ask them to arrange funds. Unless and until they pump in funds, they infuse funds, it is going to land in negative scenario. Negative in the past is something which was happened where you don't have control. But estimating deficit is very dangerous, and that got to be avoided at any cost. Okay, so never ever expect a sanctioning authority to sanction a loan proposal when you estimate a deficit in your fund flow statement, because by estimating deficit in fund flow statement, you are communicating to the sanctioning authority that this customer has no financial discipline. He is going to divert his short-term funds for long-term purposes, which no reasonable banker will agree. Okay, so in that aspect, it's very important. And look at here, they are also giving a positive projection where they are expecting the cash accruals to increase, and there are some repayment obligations, I believe. But in estimate as well as projection, it is expected to be positive. It is expected to be positive, but as a banker, you have to double ensure that they are capable of achieving it, because given the track of deficit in the past 2 years.
Are you a bank executive looking to advance your career in credit or advance profile in SME and corporate banking? Do you want to learn the pre-sanctioned credit and financial analysis skills that are essential for success in this field? If so, then our course, Credit and Financial Analysis Mastery Bundle, for bankers, is for you. In this comprehensive and structured online course, you'll learn the pre-sanctioned credit underwriting process, covering credit analysis and financial analysis specific to SME and corporate banking credit. You'll be guided through each and every step of the process, from understanding the basics of credit analysis to assessing term loans as a banker. With 15 modules and a variety of ebooks and other resources, you'll have everything you need to master this highly sought-after skill. Our course is pre-recorded, so you can access it any time, at your own pace, without disturbing your official working hours. Plus, you can access it as many times as you'd like and even download it to your mobile device for offline viewing. When you complete the course, you'll receive a certificate of completion. And with lifetime Q&A support through our Telegram group, you'll have access to the guidance and support you need to succeed. Don't miss this opportunity to advance your career in credit and financial analysis. Enroll in our course today and take the first step towards a successful banking career.